Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best that you can be. My name is HarveyBracken-Smith, and today I'm honoured to be joined with Stephen Roberts. Stephen is the founder of Orgueil Capital, which is an investment vehicle with its North Star to quintuple capital. He's the former partner at hedge fund Horseman Capital. Stephen, I'm very happy to have you. I've had a ton of feedback asking you to come back. I was going to have you on anyway, but with the overwhelming amount of listeners wanting you back on, I've had to have you back on. So I wanted to get started by asking you, what's been going on in markets over the past week and month since we last spoke?
Okay, so what hasn't been going on? You know, it's always, there's always something with markets, and I think that's what's so intriguing about them. But I would say in the last couple of months, it's been probably more about, obviously the tech sell-off, the AI bubble, which quite frankly is starting to get a bit tiring. We've got some movements going on in Japan at the long end of the yield curve. We've got sort of noise around gold, and we've also got most of the industry, because of all this volatility, is probably really underperformed this year. So we've got sort of the last innings of the year, and it's been, looking back, it's been a volatile year for the industry and as a whole.
I remember when I first became interested in investing, you gave me this piece of advice, which was just to look at the headlines from each day, and essentially that would then enable you to realize what's been talked about a lot, what's kind of just like a bit of noise, and what's the real value. And with regard to the AI bubble, it seems like people have been talking about it every day for months on end. And I've spoken to you about it, and you actually look at many of the valuations and it doesn't really seem to be there. So why do you think there's this disparity between a lot of these top companies, which actually are, Tesla, same price as 2021, many of these other companies not actually being that overvalued compared to previous years, but yet we have this constant daily rhetoric that this big impending bubble about?
I don't know. I just think, AI, robotics, quantum computing, people love talking about this. It obviously, it really gets people's sort of antennae up, especially private clients and investors. Robotics, they think they can 100x the capital. AI is this thing where there's people don't quite know what the TAM is, the total addressable market. People can get wildly excited about these stocks, and they have periods where people get wildly excited, and then they get periods where they're wildly depressed. But ultimately, if you're in this area of the stock market, that's just the nature of the beast. But the reality of stock markets, all these stocks, whilst the noise has gone on, all the performance has been elsewhere. And it's the things that people aren't talking about, which has been much easier money. And that's why I'm get frustrated with this whole AI talk, because I feel as though investors are really missing out on really what's going on in markets and where the performance is.
But surely that's an edge for you, no?
It is, yeah, completely, yeah. And that's why it's important, you need to separate the noise from the facts. And, it's very easy to read, a short line or sentence in AI bubble and then make that as an excuse to underperform. The reality is there's lots more going on.
So if most of the headlines are concentrated on AI, you've realized that this rhetoric has kind of gone on for too long and people are missing other areas. Yeah. Where are you getting your primary news sources, or how are you trying to think about your universe in terms of the stocks you want to look at to find this growth and elsewhere?
Well, I think, you look at the big performers this year, it's all in the mining space. But, private clients, investors, they know what's going on in gold. Gold's obviously up a lot this year. But, you've got some stocks in the FTSE, say in the UK, Fresnillo is up 300%, Endeavour Mining, it's up 130%, Antofagasta, a copper mine's up 90%. I'm just saying, not really people talking about these types of stocks. Even something like Vodafone is up 40%. Aviva, an insurance business, is up 37%. Banks, Barclays Bank is up 65% this year. Lloyd's Bank's up 78%. I'm saying, people are talking about AI, but there's been multiple stocks that are, if you look at the FTSE, the top 25 stocks are all up above 40% plus, but nobody talks about it. And I find that, the industry is just obsessed with AI, and what they've done is they've completely missed performance elsewhere. Siemens Energy up 137%, Heidelberg Cement, which is in the DAX, is up 83%. I can go on and on. DHL's up 35%. I'm just saying there's huge parts of the index that have substantially outperformed, But for some reason, AI gets all the headlines.
Well, a similar headline that I often hear with regard to the UK is about the lack of, graduate job opportunity, the Labour government and what they're doing, and people not being very happy with saying it's more restricted than pro-growth. And yet you look at a lot of these companies within the FTSE 100 performing so well. Why do you think, is there a general explanation that it can explain why so many companies in the FTSE 100 are performing well with the backdrop of the news saying the UK isn't doing well?
Basically, you've got a yield curve that's obviously steep. And what that means, when the yield curve's flat, banks will give you, say, 2% interest, but they only can loan, say, 5 years out at 2.5%. So they've only got a tight margin. Now, when the yield curve's steep, it means they give interest payers, obviously, the current interest rate, but it means the longer out, they can lend money out at 5-6%. So their net interest margins expand. Now, when the yield curve's steep, basically banks are super attractive because their deposit base earns a lot more money. So therefore, something like a Lloyds Bank from 2022 to say today, operating income's gone from 5 billion to 10 billion. Now, it's not because they're doing a good job at what they're doing, but basically because that yield curve's steep, like it is in the UK, then these guys can mint money. And, obviously the stock market recognizes this. People talk about this steep yield curve, but nobody tells you how to make money out of it. But whilst that yield curve stays steep, UK banks or European banks and US banks are in very much a sweet spot. And then now you've got the Fed cutting rates and the yield curve still staying steep. So therefore the banks trade has been a real big winning trade this year. And then even though, I'm just picking on UK banks at the moment, even though these banks have got up a lot, they're still only on 10, 11 times earnings, paying 3, 4, 5% dividend yields. So whilst we got this steep yield curve, then these banks will make a lot of money, and they're clearly in a sweet spot, and there's been a ton of money to be made this year on them.
But do you think that's priced in now? Like, someone hearing this now, is this something they can still trade off, or is this past historical results at this point?
Well, if you think interest rates, say in the UK, are going to be cut, and the UK government has got issues funding long-term debt, i.e. the yield curve stays steep, these banks should remain profitable for a good deal longer. And obviously the regulators say they don't need as much capital. So, they're just interesting stocks. But also you have to remember, for 4 years, these stocks flatlined. They didn't do that much. And it's really only this year that they've really had people have believed the earnings and believed the future earnings estimates. So they basically re-rated these businesses very rapidly. And I say, people are more interested about the AI though trade. That's my point.
In terms of the basic psychology of the emotional response of most investors, you see a stock go up, you're thinking, I can make more money, and maybe even a momentum trade, you might buy it and make more money. And if it's going down, you'll think, oh, I need to sell because it's going down. But if you think about it from a sophisticated investor's point of view, obviously when it goes up, it's more expensive, and when it goes down, it's cheaper. When I asked you about the UK and with regard to what stocks have had a big impact this year outside of AI, you looked at the chart with the biggest movers of the year. What would there be a certain amount that it would go up or down that would then encourage you to go about investing in the company? Because I think there's a difference between seeing how much a price moves and for that to enable you to invest in it. So how does the major price movers, how does that feed into your process?
So what you need to know is any investor needs to know who the biggest winners are and the biggest losers are. And then you need to then understand, you have to then ask yourself why. Now you just said to me, why are all these bank stocks through the roof? And I've just sort of explained why. So therefore, the investment thesis when you invest in a bank is all based on the yield curve. Now, why are all commodity stocks up a lot? Well, commodity stocks up a lot because obviously the gold mine price has done very well. Now as an investor, will that continue to be doing well? Will it continue to do well? And then therefore you can't buy these stocks if the gold price is tanking or the copper price is tanking. But then you have to think to yourself, are we in a commodity bull market? And how sustainable is a bull market? And then you have to ask yourself those questions. But I think as an investor, it's really important to know who the biggest winners and losers are every quarter, and to then ask yourself questions why that may be so. And then if you understand that then you then start looking at the stocks.
Yeah, I think something that was kind of interesting to me when I was being taught about investing from more of a theoretical standpoint at Duke was they would talk about investing from the standpoint of all the information in the market is perfectly priced into the price. So if people predict that XYZ is going to happen in the future, that's reflected in the current stock price. But what I found quite confusing about that from actually speaking to real investors is people make predictions on earnings each quarter of how well they think the stock's going to do or not do. The stock price moves so much depending on which of these cases is true. So on that point, it kind of seems that you're able to predict how a stock does and it will still do well. I know that sounds quite a simple thing to say, but it's that I guess there are different scenarios that people would expect.
Yeah,
Go on.
I think the thing is, when you're an investor, it's a bit like being, I sail quite a lot, and you know what current seas you're in as sort of a captain of a boat or what have you. But it's all about looking out 2-3 days. Now, when it comes to an investor in the stock market, anybody can tell you what market we're in today. But what they can't tell you is what market we're going to be in the next 6 to 9 months. Now, as you're captain a boat, a bit like captaining a fund, it's all about projecting where you think the seas are going to be in the next 6 to 9 months. And that's what it's all about. And that's what nobody can teach you. People can tell you exactly why something's happened, but what they can't tell you is what's going to happen. But the more experience you get to see, then you get better at predicting what you think could happen or might happen and what the risks to that are. So really investing is about, anybody can tell you a business is cheap. I can tell you Lloyds Bank's cheap, but what I can't tell you exactly is where the yield curve's going to be. I've got 80% conviction that the yield curve's going to stay cheap. But there's always those outliers where it could flatten. Now, what instances would that flatten the yield curve? And then you have to then start looking at that, and then you have to look at the market and interest rates and inflation and all these things to then give you some sense of that. Again, with commodities, what's driving commodities? Ultimately, what's driving commodities is there's many more buyers and sellers, but to produce commodities is very expensive. So therefore, something like copper, from a plain site to producing copper, it takes 30 years. So we know that even if the copper price goes up, where's all this new supply going to come? So therefore, we know it's supply constrained. What we don't then know is where the demand is going to be for copper in the next 2-3 years. But actually, as an investor, we all know, looking at our boats, it's sitting in the sea, we all know the demand for copper is going to go up because of AI and electrification and energy and what have you. So it doesn't take a genius to know probably there's going to be more buyers of copper than sellers, and actually it's quite inelastic, and you can't just bring on supply. So it's a good bet. So all I do is basically trade probability, and I invest using probability.
But even with that, I mean, there's kind of two parts to it. There's the multifaceted nature of whether it be more buyers or sellers, depending on multiple things. So you could say like the demand for copper is, going up, but at the same time, there's a massive increase in supply. So you've kind of got these two contradicting things going on in the present moment. But at the same time, you could say that in the short term, there's been a big increase in supply, but in the medium term, you expect way more copper to be needed because of AI. So on that basis, with the two separate things, one being your own personal investment time horizon, whether it's quarterly, yearly, 5 years, 10 years, or whatever it is, at the same time, the general market conditions, as you've kind of put a metaphor for that, a bit being like being on a sailboat. How do you go about thinking, like, are these the same thing? Like, do you think about your investing thing at the same time as the time horizon of the future? Or are you ever in a scenario where you think, in the next 3 months, this might be a good investment, but in 5 months, this will be a bad investment? Like, how do these two things play together in your mind?
That's hard because every sector's got its own reasons for those investments. But ultimately, they always say don't fight the Fed. If we're in an interest rate cutting scenario where central bankers across the world are cutting, then that brings a lot of investments to sort of your table. Now, in an environment where central banks are raising rates, then obviously there's a lot more sectors that are going to be affected by that. So one of the biggest things you need to know as an investor is where are we as far as rate cutting? Where are we in the cycle? And then when you start thinking about interest rates being cut, who are going to be the beneficiaries of that? What industries are going to be the beneficiaries of that if it happens? Now, some people are in the camp that we're in an inflationary environment forever and interest rates are never going to be cut. So you could say they're the most bearish people at the moment in the stock market. The most bullish people are probably the people who are saying interest rates are going to be cut aggressively and GDP is going to sort of react and inflation is going to stay tame. And that's sort of the bear and the bull. We're probably going to land somewhere between that. But really, that's when looking at the market, that's what it's all predicated on.
I like your idea on that. Where we are today, we can make theoretical predictions from the future, but as the future actually becomes today, things change, right? So like predicting the couple of days on the sailboat, just like the 6 to 9 months in the stock market. How do you go about, you mentioned all these different industries have different time horizons, different things that impact them. You said don't fight the Fed, but even if that's the main macroeconomic point, there's still different things in each industry. How do you go about physically staying on top of everything within each industry? Like if you have a prediction that's say in like the oil and gas markets that there's going to be something happening in 6 months time, but then in tech maybe something happening in 2 weeks. Like do you use a calendar to actually formulate all these thoughts and predictions?
No, not at all. If you think about AI, at the end of the day, AI is very unpredictable. So we've put $1 trillion of market cap on Google because everybody's decided Google's a winner. Whereas 4 or 5 months ago, they said it was a loser. So therefore, the biggest businesses in the world are being disrupted at rapid paces, and sort of the whole AI bubble is making these investments very difficult to hold. Now, if as an investor, would you pay a higher PE for that or a lower PE? I would argue in the environment when all I read about is AI, I would pay a lower PE for these businesses simply because they can be disrupted in a minute. DeepSeek showed us that in February. Google, OpenAI, the battle there, that's affected, as I say, a huge portion of the market cap of the whole industry. So therefore, in some ways, it bizarrely makes these businesses less attractive. In my position, because I can't predict them, I can predict much more so other sectors of the stock market where I would also say most of the money's being made. So I like the fact that everybody's just running away with this AI, this AI rhetoric, because basically there's a party going on and they don't know what's going on in other parts of the stock market.
I actually really like your way of thinking about that, because something I was thinking about over the past week is I saw a really interesting article about HSBC with OpenAI, because OpenAI is being valued at roughly $500 billion. But at the same time, HSBC did a report where by 2030, they're predicting OpenAI to have to spend another $208 billion just to get to their base case scenario. It almost seems as if these big AI companies, particularly OpenAI, the base case seems like a super bullish case, in that it seems like they have to do so much, make so much money, and basically change every single industry on the planet just for the base case to be so successful because of the hyper growth within such a short period of time. Whereas I thinking, okay, well, there's whatever percent that happens, maybe it revolutionizes things, maybe it doesn't. But what is kind of guaranteed in a sense, what is kind of guaranteed is the huge amount of energy that's going to have to go into these systems, whether it's DeepSeek, OpenAI, or whether it's Google or Perplexity or whoever it is, they're going to have to use enormous amounts of energy. So I bet on energy companies and natural resources. Another thing that is really interesting is data centers. All of these companies are having to build data centers. So you could both look at the materials and also the actual businesses which are offering the manufacturing for these businesses. So I think it's quite an interesting point because everyone is focused on the big what if bet, but there are sort of these mini, more guaranteed or much higher probability bets that are going to happen, which 200 billion, as I just said, is such a large amount of money that is actually going to have an outsized impact. Whereas I think everyone thinks that because OpenAI is going to change everything in theory, that is the only bet people can bet on.
Yeah. So therefore AI is going to bring in commodities, and actually that's where all the money's been made this year. The commodity stocks have been fantastic, and also where the money's been made this year is where the market got comfortable this summer that the Fed's going to start cutting rates, and tariffs weren't as inflationary as they thought. So therefore, if the Fed lands around 3% in the US, certain portions of the stock market look super, super interesting.
If you were to look at the past, if you look at each decade, one decade, and you look at the top 10 companies in the world by market cap, each 9 would probably change from decade to decade. I mean, maybe there'd be 2 where Microsoft is in there and maybe some big oil companies as well. But for the most part, they change. But within those 10-year time periods, many of those companies kind of retain similar amounts of market cap. It's just that they've been changed by an even bigger one. Do you think, you mentioned that Google was down 30%, ended up going up more than 110%. Apple was down, then rallied as well. Do you think this is a continuing trend of the biggest companies in the world reaching huge valuations, but then also going through such high value volatility within each year?
Exactly. So if you as an investor want to play the Mag 7, and again, I don't want to particularly go on about the Mag 7 because I just don't think there's tons of money to be made, but you have to witness 20, 30, 40% drawdowns in those names as they go out of fashion and come back into fashion. Why even try and compete in that arena? I sort of trade around the rhetorics, but as long-term investments, they're more and more difficult to hold. Even Apple, the actual iPhone itself, this thing here, nobody's going to ever take that off me, ever. But never say never. Meta glasses, all of a sudden, the hardware is this hardware going to morph now into eyewear? Now, I wouldn't bet against that. So even Apple's moats, we saw it with BlackBerry, Apple, Nokia. Nokia, nobody thought Nokia would ever get displaced, but it did. So, will this iPhone ever get displaced? Never say never. I don't think it will, but never say never. I'm just saying technology is moving so quickly. Google could get displaced. These are very big statements, and all I'm saying is, as an investor, expect mass volatility. And there's going to be some very big winners and there's going to be some very big losers.
I was listening to a Joe Rogan podcast with Elon Musk a few weeks ago, and he was predicting that consumer devices such as the iPhone will be displaced by things that are fully AI. So I don't know whether I would fully agree with his statement, but he was essentially saying that you'd have a device fully AI, you wouldn't have any apps, you wouldn't have anything. It would all just be the AI, and it would basically be perfectly curated to what you're doing. So he's making that big bet in terms of what he's doing with XAI. Similarly, OpenAI is working with Johnny Ive, who helped to design the iPhone, to create their own consumer device. Obviously, Meta is creating the glasses, as you mentioned. So there is this big possibility for this big change in consumer devices. What sort of direction do you think that the future will look like in consumer devices?
I don't know. The question is, I don't think anybody knows. I think ultimately, all I'm saying is glasses could take over the hardware, or they're going to work in tandem. But ultimately, as an investor, the biggest thing to know, I would say, that I've learned is don't worry about AI. It's all about how AI could maybe affect future interest rates and future economies. Are staff recruiters going to be around as far as, Randstad and, how you look for a job? That's going to completely change. Drugs discovery, is going to completely change. So therefore, every sector of the stock market, mobile telecommunications, now with people like Starlink and satellites, it's going to go from 3G, 4G, 5G to maybe into outer space. So therefore, technology is moving so quickly. Banking, how is it going to affect banking? It's going to affect, so how is crypto going to affect banking? Technology is in every sector of the stock market. And when you own a business and equity, it's very important to keep on top with what's going on at AI, because it could affect and destroy the business you actually own. So therefore, as an investor, I understand AI to a point, but more importantly, I know how it could affect and maybe dislodge any of the stocks I own. So just think, as an investor, it's important to think about AI, how it can invest your investment.
I do think that AI is slightly different from the metaverse, but just going back 4 years, I was finishing school, and then even kind of 2022, I started working at a VC firm, and it was kind of the end of the 2021 to 2022 bull run with cryptocurrency companies and also with metaverse and NFT type companies. But I remember every news channel, every YouTube, every cable television, or whoever went on, every self-proclaimed expert was saying that the metaverse was the next biggest thing. Obviously, Facebook changed its name to Meta, and it was this big bet. Whereas now we're seeing that Meta might actually be changing its name. We've got some prediction markets saying they might change it to Zuck, which would be interesting. And they're also laying off 30% of the workforce that was working on the metaverse. When you hear the whole world telling you something, right now it's this AI bubble that you're kind of sick of. A few years ago, it was the metaverse. There's still these big AI stories. How do you go about blocking out the noise from experts who maybe made some really good bets in the past, but aren't necessarily going to be right about everything? How do you block out that noise and have conviction in what you're doing when there's such big noise from the media, from experts, from people all over the world?
It's not a case of blocking it out, it's just how you join the dots of it. You know, at the end of the day, Zuckerberg's now pivoting from, as you say, the whole sort of his big bet on VR to now much more, it's all about the data sets and mining data. Now, that business, the Meta business, what's it called, Reality Labs, that was losing huge amounts of money and the market is not happy with it. So therefore him reducing capex into that and pivoting into AI, which you could say he obviously knows he can monetize quicker, it is a very sensible thing to do. And he pivots very quickly, Zuckerberg. He doesn't mess around. That's why he's one of the most successful entrepreneurs in the world. So I really like that news. And I also thought Reality Labs was always a bit, I couldn't quite get my head around it. So I quite like the fact that he's done that, and that's why the stock price is popping. So therefore, if you're an owner of Meta, that news should be very welcome news as far as I'm concerned.
Is there any part of you that will start considering to invest in private markets? I mean, we're seeing like these huge companies that would usually go public and are now staying private for longer. Well, you said no, so why not?
Because you have to tie capital up forever, you know, until somebody decides to let you out. If somebody said to me, you give me some money and I'll decide when to give it back, I'd say no thank you. And it's as simple as that for me. And okay, we can mark to market it and I can tell you what I think it's worth, but it's only worth what somebody's willing to give you, actually physically to give you the money. So therefore for me, private markets are something you should do as far as, you know, a balanced portfolio in very illiquid things that, you know, 7 out of 10 probably go wrong, and the 3 that go right is the ones they talk about and they market it around. So, you know, whilst if you've invested in private markets and say post the financial crisis, you've done very well because there's been some massive winners. Now, are there going to be massive winners investing now in the next 15 years? Probably. But if you've got the right vehicle, you might be able to, you'll do well. But if you've got the wrong vehicle, you're going to have your money tied up forever. So, you know, I as an investor like liquidity of the stock market. That's why I like the stock market. I don't like the illiquidity of private equity. I'm not saying that you shouldn't do it. I'm just saying you just have to realize that there's no liquidity. And what you end up doing is selling your liquid things if you need the cash to fund these illiquid things. So you basically can be side pocketed with a lot of illiquid things that you can't liquidate. So just think about that. I'm not saying don't do it. I'm just saying it's not for me.
Yeah, I think it's a good focus on what you're good at. I mean, it's a very classic and overused phrase from Warren Buffett in which he only says to invest in what you know, and it's hence why he hasn't invested in cryptocurrency, for example. I think the only reason I mention it is less of a point of, oh, would you consider doing private markets, but purely from the systematic trend when companies are getting so huge. We're kind of seeing an uptick in M&A activity starting to come up again. So more companies are starting to IPO, but there are these mega, like $10 billion companies that are staying private. So I think that's why I asked the question. Do you think that there is going to continue to be as much alpha to be generated in the UK? I mean, you kind of mentioned some of the steep yield curve, which is enabling the banks to do well. Obviously, the commodity type companies are doing well because of what's globally going on with gold and things like that. But I think I saw an article a couple of months ago where the UK was one of the lowest in terms of IPO activities. I think only doing like $200 million for the year up to the point in September. Like, are IPOs a big part of your business and what you look at for public markets in the UK? Or is it just kind of like a small piece of the enormous puzzle?
Generally, you don't want to buy shares in a business that needs money. You know, the old days of IPOing is ultimately to they say to increase your profile. It was you know, to give you a capital markets sort of, you know, front of house seat. You know, any business that came to the stock market that needed capital, you wouldn't be able to raise money. People want to invest in things that don't need capital. So therefore, the stock market's a really strange for doing these things. And if you can raise capital in private markets, why wouldn't you? So therefore, if you can't raise it in private markets, there's no way public equity would give you the options. So I would say the stock market, I think over time will evolve into less and less businesses.
On the basis.
And yeah, I just think, and they're good businesses private equity will probably be bought out by the bigger players, and you're going to see more and more probably over the next 20 years. You're probably going to see less businesses on the stock market. The stock market will be something with highly liquid businesses with bond type returns, as opposed to this speculative, raising money.
I want to go back to Europe and Asia, and I know you don't like talking about the AI point, but please correct me if I'm wrong, but I think that we previously spoke about a lot of the returns in Europe and in Asia more broadly coming from the success of AI in America, and that kind of transferring to Asia and Europe because they would give them business retrospectively. On the basis, let's say that AI wasn't as big as we all think it is, and although there might not be an AI bubble in companies like Tesla priced similarly to 2021, or even Amazon not moving much this year, and then even Apple and Google, which have fluctuated a lot in the last year, but still in a lot of other companies, on the basis that AI doesn't do exceptionally well over the next few years, do you think that there will be major implications for Europe and Asia? And as a second part of that question, where would you look to invest?
Well, as in the big tech stocks in Alibaba's done very well this year, it's up 85%. Tencent, again, their biggest sort of tech business this year, that's up 46%. So I think what had happened in Asia specifically is these big tech companies got really, because everybody's obsessed with the Mag 7, they got left behind. And now these businesses are obviously fighting back. They're putting capex into cloud. They're starting to grow the business. The Chinese economy looks like it's turning or slowly turning, hasn't quite turned yet. The valuations were a lot less. So I think this year you've seen a big catch-up trade where all the other big incumbent AI type tech businesses globally were left behind. They've all caught up as far as valuation. They're still not expensive. So something like Alibaba, it's on 25 times forward earnings. It's got a lot of cash on its balance sheet. Its cloud business is growing now very nicely. It's now profitable, its cloud business, and effectively it's a monopoly in China. So it's got 38% market share in China, the cloud market, and it's only got 4% globally of the total cloud market globally. So it's really a monopoly in China, but also it's probably going to expand overseas. So these stocks look, even Alibaba after its run, it still looks relatively cheap. But then if you look at it over 5 years, this stock, Alibaba, over 5 years is still down from its highs in 2021. It's still down 40%. So it could still go up 40%. And it'd only still be where it was in 2021. Which either shows you it was overvalued in 2021, or it's obviously extremely undervalued now. So, it looks a good bet.
I think something which I underappreciated the minute AI came out, and I think it's still a rhetoric that people are talking about today, and there's kind of gone down a little bit, been muted about, I'd say 10 or 20% in terms of sentiment, but it's still, pretty high up with regard to the idea of AI, is that it would replace everything. But I don't think I realized the true power of the incumbent. So even when you talk about Alibaba, or you talk about some of the biggest banks in the world, or whatever it may be, a lot of people like to work with people. You're putting a company working with a startup to build an AI solution within a company. I think that is very different to suddenly Salesforce being replaced, or Apple being replaced, or Alibaba being replaced, because many of those customers, because many of those people are in their historical ways and aren't just going to switch straight away. It's even like a lot of people say that banks can be quite slow to adapt new innovative tools, when actually this is seen, I think this shows a bit of a benefit in that it's not like AI happened day one, super intelligence happened day two, and everything gets replaced day three. It's sort of this slow evolving thing.
Yeah, I think looking at AI, it's going to increase productivity, isn't it? Now, the equity market in general will do well when you've got big increases in productivity. Something like the UK economy, we've had decreases in productivity. Per capita GDP is falling, productivity is falling. So therefore, if all these businesses can embrace AI in their business, then they're going to improve their return on equity. Now, if you've got an environment where you've got improvements in return on equity and margins increasing, and interest rates slowly falling, you've basically got a cocktail for the stock market to go up. It is as simple as that. So therefore, the AI is going to affect the macro, and I would say this year AI was going to affect the macro from a bullish perspective, increase in productivity, and we're seeing that. Google now employs slightly more people than it did 3 years ago, but its turnover is up 50%. So these big tech companies have shown us that they can put AI in their business, grow the top line without taking on employees. Now, if every business in the world does that, then the shareholders are going to be happy. But where it hits the real economy is like if they don't need 10-15% of the workforce. Like if it does cause massive increase in the unemployment rate. And what we're seeing now with the US numbers, talking about this is about joining the dots, we're seeing the US economy start to shed jobs and people aren't employing, especially young people. So if you run a business, you can say, well, actually, I'm going to bring AI into this business, but I don't need to take on these graduates because I'm just trying to look at my business at the moment and streamline what I've got. I don't need more people. And I personally think, whilst people say every industrial revolution is going to create jobs, I'm not sure this industrial revolution will create jobs. I think it will create jobs in certain areas, but I do think these big increases in productivity that come through could be at the cost of the workforce. So therefore, I personally, talking to you last time to now, I personally think there's now more risks of the unemployment rate worsening quicker. Now, this would basically be bad, not great news for the stock market. So at first, we're in this inflection point where we got this big increase of productivity, lower rates. But at what point does the stock market go, actually, we could have unemployment rate in the US going to 5-6% and have a chance of a recession, and the Fed can't cut enough. Now, and it's a structural issue with the employment market. So, where does stock markets land then? So now I'm thinking about AI, I'm thinking about being in this boat, and I'm now looking out the horizon and I can see the employment market worsening quicker.
I actually got quite a few dots that I want to connect because I think it's quite an interesting point. If you were to look at the UAE, for example, which is even places like Dubai, and you look at their unemployment rates, they get up to 20-25%. And the reason why I think that's interesting with regard to AI is the labor costs are so low in places like that, that's almost like an example of an economy where people aren't being, the actual unit of labor is so cheap that it's almost like AI. People aren't being driven towards service type businesses. They're actually staying unemployed, particularly youth unemployment in those countries is incredibly high. So that can be seen as an example that when you have an increase in productivity and a decrease in cost from AI, that's what's going to happen to the people. Another thing that I thought would mention, another thing from Elon Musk on the Joe Rogan podcast, is he thinks that there are only so many human desires, eating, drinking, safe housing, whatever, medical costs, whatever it may be, that he believes that AI will get to a point where many of these things that we need in our lives will be done by AI. You can almost think of the Disney film WALL-E with it. And the last point that I would make is, and I spoke to you about this last time as well, is that I'm of the belief that the Fed's primary things in terms of unemployment rate and in terms of inflation, the inflation thing will stay there. But unemployment, I think in the past, there's been a correlation between the less unemployment there is, the better the economy will do. You've just pointed out with Google, as the employment rate has stayed the same, the business has still been able to grow. So these two things aren't correlated anymore. So I think that will lead to, the only big problem that it will have is in terms of, will an increase in unemployment rate lead to riots? Will it lead to uprisings? Probably. So that all these people will need to have something to do. They might need to have money from elsewhere. But I do think that it will actually fundamentally change the entire system on how we assess success in the economy.
Yeah, but as I say, as an investor, you just have to realize that this industrial revolution is going to create some big winners and it's going to create some big losers. And as an investor, you just need to be aware of these things. And the macros at the moment, I would say most people are still in this inflationary camp. Now, how can that rhetoric on inflation, and I understand that rhetoric around inflation being sort of remaining stubbornly high as the Fed cuts rates. That's really good because you've got a bit of inflation, you've got the Fed cutting rates. That's great for stock markets, right? What's not good for stock markets is when the Fed's cutting rates, inflation stays high and the unemployment rate goes up. Now the stock market's not going to like that. So I'm just saying this is a scenario that I think, from my readings, could happen. But I also think what we've shown with technology is proven, if anything, to be deflationary. So up to COVID, nobody could understand, with all this money printing, why inflation wasn't moving higher. And I think it was all to do with the disruption of the internet and, being able to price check, and Amazons of the world and everything. The internet's made everything much more efficient, which has put a lid on inflation. And then we've had this inflationary spike. Now, most investors are saying we're in this now for the next 20 years. Inflation's in the system. It's going to be decades to go away. Get that. But I also think, how can now technology not be inflationary? Is this tech AI revolution, is it deflationary or inflationary? And I think there's a big pull, push, drag going, more of an argument around that at the moment compared to 3-6 months ago.
But I would presume, and please correct me if you think differently, that a lot of the reason that the people would price in the economy to do worse on the basis of increasing unemployment is because there would be less spending, which would then decrease the money cycle, which would mean that
more
less money
social
goes to
security, more social security. If all of a sudden, I was born in 1972, and I think the unemployment rate in the UK got to, 10 or 11% unemployment rate, sort of early 90s. Nobody really post that time has seen unemployment rates up at those levels. US unemployment rate, the US economy, the US employment jobs market is at record still lows. It's quite incredible. You've got 4% unemployment. Or 4.4%, whatever, in the US. But if you look at it over 40 years, it has been up to 10%. And all I'm saying is, most investors haven't got the toolkit or knowledge of economies when you've got mass unemployment. And it comes at a time when the bond market, certainly the US, can they afford to have this many people unemployed? So therefore, long-term yield, long-term bonds could sell off on this scenario. And I'm just saying this, I'm not saying this is going to happen. I'm just saying these are all things we have to think about.
I guess that's the part I hadn't thought about it as much, is because a lot of these businesses rely on getting lower rates to invest in their businesses. It's not just about how much money they can earn from selling goods. They also need the bonds to go about, building up the business. Because I'm looking at what I was going to say, if you ignore the bond element and you mainly focus on how much money the business is getting in, like, for example, like a clothing selling business or retail or restaurants, whatever.
I just say though, Harvey, every investment you make, right, everything is built from where bonds are. Now, if long-term bonds are at 6-7%, why, as an investor, if you can get a 6-7% guaranteed return from the US, it would make tech businesses or businesses with low yield 2-3% not attractive, so you would sell them. So as an investor, you always have to, like being a sailor, you have to think about where you think interest rates are going to be, because every investment you ever make is determined by that risk-free rate. And I just don't think people think about that enough, and that's why I've sort of interrupted you saying that. That's one of the biggest things as an investor, to think about where you think the risk-free rate's going to be. If you think the risk-free rate is going to be at 4, 5, 6, 7% in 5, 6, 7 years' time, maybe don't invest in equities. If you think the risk-free rate's going to be 1 or 2%, equities look very, very, very attractive. So therefore, everything is where you think the risk-free rate is going to be in the next 4 or 5 years. And that, as an investor, that's what I think about a lot. I think it's a really important. Where's Bitcoin going to be if the risk-free rate is at 6-7%?
Probably a lot lower.
Yeah. So therefore, these things you really have to think about the macros.
Well, on that point then, I'm just going to read you 2 sentences. This is from the 2nd of July, 2025. I think it's even worse now when we talk about the autumn budget. But I'll read this from The Independent. So, what percentage of the UK population is on benefits? Some 9.9 million working age people, 92.8% of the working age population, are receiving some form of benefits according to the latest DWP figures. In addition, 13 million above state state pension, age 67 over. This amounts to 14.5% of the population as a whole. And also the other important thing to note, Hemi, who is the leader of the Conservative Party, you know, the shadow cabinet, put out an Instagram post the other day. And she says that in order for the working age person to earn more than someone on benefits in the UK, they have to earn more than £71,000. So what do you think will be the overall result of this kind of bloated economy where so many people are on benefits in the UK with regard to the over impact on the economy in the UK moving forward?
Yeah, I don't know about that stat of 71,000, but, you know, I think what we're saying is, as far as the UK now is it's a European country, it's a socialist state. The UK is a socialist state. And what you're saying, alluding to, is that if you haven't got a job and you're on benefits, it's not a bad place to be. And probably because it's not a bad place to be, that's why you've obviously got this immigration problem. You know, you can't blame people if they come over to the UK and, you know, they're looked after. So you can't blame them for that. But the problem is that if the unemployment rate goes up, you've got a situation now, the unemployment rate goes up, the Bank of England will start cutting rates. The big problem is if he's cut rates, inflation stays stubborn and the unemployment rate goes up. Now, at that point, can governments afford another few million people unemployed? And I think the answer is clearly no, they can't. They can just about afford what they've got now. So this could lead to political turmoil. And I hate to use the word turmoil, but basically it's the political parties. To be a socialist, you need to be able to afford to be a socialist. And I think what you're finding with the UK at the moment is while we all look to be socialist, unfortunately, people don't want to pay for it. So, and they certainly won't want to pay for another 2 million people unemployed. And all I'm saying is the AI revolution could be really bad for governments because it could force unemployment rate up and we can't afford it.
Yeah, here's the, I won't give you the full quote, but just like part of it, it was saying a working family needs £71,000 just to match the income of a jobless 3-child household. It's because they also increase the amount of money you get for having an extra kid.
Yeah. As a household, as 3-child household, is that?
3-child, yeah.
You know, that makes sense, doesn't it? Because, you know, I think the weekly shop now in the UK and US, you know, just the weekly shop food costs and what have you, it's so high. You know, personally, you know, I've got 4 children. We go shopping and we spend hundreds and hundreds of pounds, and you just don't feel as though you've even got anything. So, you know, how people get by, a large family now of 3, very expensive. And that's why, you know, having a child is a business decision. You need to be able to afford a child. And, you know, the reality is it's very expensive to have a child. And these people who make these choices to have a child or not to have a child because they can't afford it, you know, should they be paying for the people who say, actually, I even though I can't afford a child, I'll have a child? And this is what argument we're in at the moment.
I saw something interesting article earlier today, and one of the biggest stories of the year has been the Trump tariffs, and there's kind of been them on, they're off. Recently, there's the debate with the US and China with regard to the US stopping its tariffs, and in return, there being a freeze on stopping, allowing rare earths to go from China to the US. And there was also the soybeans from the US to China, and more recently, there was the US recently detected some Chinese spies that have actually decided not to go after them to enable this agreement to keep taking place. One of the big things that Trump has wanted to do, because many of the people that had voted for Trump wanted him to bring manufacturing back to the US. We've had multiple conversations on this podcast saying that's not that feasible because the average worker in the US, the minimum wage is so much higher than it would be in, say, like Indonesia or China. And on top of that, the actual know-how that they have in China is so much higher than the US, so it's much harder to do. But despite that, I saw today a report from Mayoshi Son, the CEO of SoftBank, saying that he's going to invest hundreds of billions to build Trump branding industrial parks around the country on federal land. What do you make of this article? Do you think that they will actually succeed in bringing industrial stuff back to the US? What do you think the play is? And do you think this is more of a political, like being nice to Trump, or actually a proper thing to invest in?
Well, the facts are people are. So, you know, if you look at the big pharma companies, they've all announced big increases in capex. Now, you know, the naysayers will say, well, they're going to do that anyway. Well, if they were, they didn't talk about it. And I think some of them were going to, obviously. But now I think the policy to bring back to manufacturing back to the US on the basis that, they are such a big part of global economy, completely makes sense to me. And I wish more people would do that. I wish more politicians would say, you need to bring manufacturing back. And we're talking about this. We weren't talking about bringing manufacturing back into the US. There was policy around it, whereas Trump's so vocal about it. I only can see the US economy doing well out of this. I think it's a great idea. And, the companies who don't, he will pull them over the coals probably. So, yeah. And I think you have to remember, he's got Elon Musk. He did have Elon Musk in his ear. He knows AI is going to bring big disruptions to the jobs market. I don't think European or UK politicians are even talking about it. So I think Trump is well advised. He knows AI revolution could be bad for the jobs market, and now's the time to get jobs back and manufacturing jobs back. So I get it. And as far as the China, ultimately China's now got this rare earth card. America's got this Nvidia card. So this is where the politics have got to. They're quite powerful cards to play. And the two power brokers, these are the two pinch points. So I'm sure we're going to hear more about rare earths, Nvidia for a good deal longer. Yeah, but ultimately China's ultimate card is the rare earths.
One of the biggest things that impacts the market cap of a company is when it gets added to the S&P 500, because many index funds have to actually buy that company, which increases the liquidity of that company even more. One of the things that Trump has introduced is giving $1,000 invested in indexes for newborns. And yesterday, Michael and Susan Dell announced $6.25 billion of money that they're donating for $250 to go to under 10s in the US, 25 million kids. What impact do you think having so much money both for newborns and also under 10 kids in the US will have on the economy? Do you think we'll see a continuing rise in companies doing well just because there's so much money invested in them? Or what sort of impact do you think we'll see?
One of the big things that stops people from retiring is their pension pot. Certainly Europeans, people from the UK, I think the average return on somebody's SIP in the UK over 20 years is 1.2% something. It's actually below interest rates. It's actually below sort of what you can get in the bank. And it's because people aren't sort of savvy when it comes to the finances. They work all their lives, they work really hard, but they always make bad investment decisions, or they get into products that charge a lot of money, or I don't know, they end up buying robotics businesses on 200 times revenue and losing all the money and all these different things. But ultimately, if everybody can invest, even in the US, if people can be aware of, have some financial wealth, knowledge, and they can build on that, then effectively it's going to help with retirement. So I sort of champion it, and US are a very sort of pro equity culture. This is only going to, solidify it. There's going to be a lot of these people who get this $1,000 time, it'll grow, and then they'll go, actually, I'm going to add some of my money to it. And, now with, interactive platforms and trading platforms and the internet and all these different things, people can do research, and the next sort of Warren Buffett's can be born. So I really love the pro equity culture of it, and I think it's a fantastic idea. And I just think more government should do that, as long as, the bureaucracy around it is not difficult. So I think it's fantastic news, and the whole engagement with owning a bit of America, I think it's just fantastic.
Do you think it will change the investment landscape in any way?
Yeah, because it's going to bring more people into equities. So you look at the UK equity market, it's dead. It's dead because, people haven't been encouraged to think about it, to invest in it. It's going to affect people's retirement, and, Europe as well. There isn't an equity culture. I just think Europeans just think it's something for the rich. People in the UK think it's something for the rich. But I started investing as a kid, £50, £100, and I was sort of the Thatcher babe. I fell in love with the stock market, and that's how what I'm doing now is because that spark was generated. I don't know how, but it was. And what the US is doing is going to cause many sparks for many people.
My last topic: Black Friday sales are up 4.1% according to Mastercard, with luxury goods seeing a 21% increase in Black Friday sales from last year. Still the AI thing, people saying there's a bubble, but yet actual spending is up. What do you think this means for the broader market?
Well, I think if the Fed's going to cut rates, inflation stays where it is, you've got governments across the world still spending lots of money, and equities are going higher.
Do you think there are any particular names, buy or sell, that you'd want to mention that you maybe have a different view on since we spoke last month?
No, not really. I just think it's important. Banks will keep on doing well and minting money if the yield curve stays where it is. Commodities will do well. If this AI energy build out happens, aluminium, copper is going to suck in all these things. That's going to still remain a sweet spot. If the Fed lands at 3% rates, that's very supportive when thinking about the risk-free rate and investing. So, the backdrop's good. I think the big risks are, employment market, AI, its effects, and as it's rolled out across many businesses, whilst there's going to be big increase in productivity, the downsides of that is people's jobs could be at risk.
Well, thank you very much for coming on today, Stephen. We spoke about a range of topics from commodities to banks, retail investors, volatility with Apple and Google, and more flat companies such as Amazon, Tesla, emerging markets such as Europe and Asia, the AI trade, Meta, wearables, Apple, OpenAI, lower rates, the autumn budget. We spoke about investment back into the US, investing accounts, Black Friday, whether or not there is an AI bubble, and where else to look. I feel honoured to speak to you again today, Stephen.
I'm worn out after that.
Yeah, I learn a lot as always, and thank you.
All right, no problem. Thanks. Great seeing you, Harvey.